My name is Micklethwaite. I'm managing partner of the Brown Rudnick London office, and I'm very pleased to be here with quite a distinguished panel. John Lazar from Burford Capital, who's managing director with responsibility for overseeing the growth of that business in Europe, and was previously, obviously, with Burford in the US, where I think, John, you were right at the coalface in assessing claims and taking them through commitments committee as well. Yep. John was previously a litigator at Cravath and at Warmouth, Mayer and Deutsch, yep. Which is a specialist litigation firm, to those who don't know. I'm also here with Rocco Pirozzolo from Harbour Underwriting. Rocco has been at the forefront of developing, legal risk insurance over many decades, and also has been, involved with Harbour on the funding side previously as well. So he can give a perspective from both aspects. At the end, I have Nadya Berova, who is legal counsel for Africa and the Middle East for Barrick Gold. As you may know, Barrick Gold is a major mining company, particularly in copper and gold across numerous jurisdictions across the world. I think Nadya has great experience in the international arbitration side of things as a result of that. Previously, Nadya was in private practice. And I think for the first time I can say she's the only person I know who's also qualified in Northern Territory, Australia. Lastly, but not least, Akther, who is from Siemens Energy. Suba has been with Siemens now for 17 years and is a solicitor advocate and head of the litigation side. As you can imagine, with Siemens being such a vast and broad company, those disputes cover all sorts of sectors, from construction through to energy, rail, and the like. Suba also leads as an advocate in a lot of those cases, and apart from working with law firms, also works directly with the bar and has much trial experience himself. Prior to Siemens, Suba was working in private practice as well with DLA Piper and with Pinsent Masons. So thank you all for coming today. So the idea of this session is to look at the in-house perspective towards litigation funding, which I hope will give us sort of a somewhat interesting contrast of views from our panelists. I hope interesting because I know you're probably all getting a bit hungry and we're running over a bit time, so I'm going to try and keep very much on track. I think everyone accepts that litigation fund is now, an increasingly important part of the commercial litigation landscape. I think everything that's been said this morning shows that. But with general counsels, there's still a level of skepticism about where it fits in, particularly with general counsel with very well-funded balance sheets, or companies with very well-funded balance sheets. And so it'd be interesting to see, what our panelists think are the sort of drivers, both from the funder's point of view, but also from the corporate point of view, as to why corporates might use litigation funding in future. One of the things that I don't think is in doubt is whether as a defendant, or as a claimant, or as a winner or a loser in litigation, the fact is litigation is incredibly expensive. As Stephen Friel has said, some of the costs you hear in litigation cases now do defy belief. It also absorbs a huge amount of management time. It distracts corporations from their key business interests. And so, within that, I think is, some of the sort of foundation for why businesses who are facing numerous claims, particularly as defendants, might in the future start to explore litigation funding more readily. So on that basis, start exploring that topic, firstly with John. I mean, John has been at the forefront of developing your business with corporates, I think. Yep. What have you seen as the sort of drivers towards, or the themes that are coming in the conversations you have with those potential clients?
Yeah, thank you. I think the first point we'd make, and we've talked about here, is really education. So teaching GCs and heads of litigation about what litigation funding is. That's been a long effort in the US and New York in particular, and certainly over here in London, and even more so in Europe. And that even goes down to the basic ideas of we don't take control of the claim, we don't have settlement authority, we don't interfere with the corporation's relationship with their counsel. That's all very important and sacrosanct. So when I talk to GCs and heads of litigation, especially over here, I think those basic points are a good starting point. But as I was taking a step back, we were just talking about the fact that in the U.S., 12 years ago when Burford started, we were really focused on teaching law firms and lawyers about what litigation finance is. Really, just practically speaking, the idea being it's easier to talk to the 50 biggest law firms in New York who have lots of great clients than going to 500 or 1,000 companies who may or may not have claims. But as that business progressed, a lot of those deals went from law firm or lawyer side deals into corporate deals. And I guess with that backdrop, it's even more true over here. As everyone knows, law firms either can't take risk or are willing to take a lot of risk where they can in maybe DBA land or in Spain. So pretty much all of our deals in UK and Europe are with corporate claimants, are on the claimant side. So there already are a lot of those deals out there. Obviously, we just can't really talk about them for the most part. But some of the benefits, I think, for in-house departments, to me, the primary one is helping them bring claims that they might not otherwise bring. I think everyone appreciates that GCs, heads of litigation, have limited budgets. And frankly, they have affirmative claims that they just don't see the value in bringing. That there's no upside for them. So if they have a claim that could be worth 50 million sterling or whatever it is, it would cost them 5 or 7 million sterling to run. Well, if they dedicate that part of their budget to that claim and it wins, well, they don't get the upside, right? That goes to the CFO, that goes to the company. If they lose, then, well, they look bad to the CEO, to CFO, to everyone, because they just wasted 5 or 7 million of their budget for really no benefit. So once you start there, and we can say to them, we'll take all of the financial risk. Sure, we'll take part of the recovery because these are non-recourse investments, so if they lose, the case loses, they don't lose any money. But if they win, it's almost like found money. And I guess to that point, too, we've seen, I think about 2/3 of the companies in the U.S. we talk to already have affirmative recovery programs. Some of them are kind of nascent, so we help them build those out in a more intelligent way, especially using our in-house data, because we have a ton of it, so that they can actually more efficiently prosecute those claims. And we can also, as part of our investment, take part of that management process off of their plates. So it's all meant to make that easier for in-house GCs, in-house heads of litigation.
But in terms of, you should say, giving them the, or taking the risk away from allowing them to pursue claims, does that sort of mean in your mind that that's the sort of more marginal claims, or would that, do you have experience with corporates where basically they take that approach with all claims?
With all claims, larger claims too. And we do have sort of funny minimums at Burford, so smaller claims might not be interested unless we package them together. But generally speaking, it's even the larger claims too. And they have various reasons for not wanting to bring them, depending on the business. But we talk to companies about breach of contract, antitrust, intellectual property, the full range.
Mm. Yeah. And in terms of the themes you hear, in terms of resistance of corporates from taking litigation funding, what do they mainly consist of? I
think the primary point is usually just really teaching the basics. So I have one good example with a very sophisticated company in the U.S. recently spoke to their GC and some senior folks in legal, and we were trying to talk about litigation finance, and maybe we were too in the weeds on how it all works, but finally said, well, in this case, if you opt out of this class action, we'll give you X million dollars. And then all of a sudden, that got their interest. And then they got more into the weeds of how it actually all worked.
Super, maybe offering a different perspective from a very large corporation with a very strong balance sheet. I mean, I assume you get approached by funders. How do you generally view that?
I mean, the starting point, Neil, is Siemens is a large conglomerate. Its business isn't disputes and litigation. Our primary focus within litigation is to A, avoid them, or B, manage them as cost effectively as we can. And cost effectively can have several strands that you look at. Now, unfortunately, disputes are part and parcel of business, and we find ourselves, for example, we're a frequent user of ICC arbitration and so on. So we'll have a very rigid structure right from the outset, from even before we enter into contracts. We'll have, for example, red, green, and amber countries, jurisdictions which we can accept. So taking that into account, if we have a major dispute, and often it's not easy to identify which dispute will snowball into something that you didn't anticipate at the beginning. It might start off as a small issue and then mushroom, and by that time you're already into a track before you've even looked at third-party funding. But coming to the issue that John said about teaching, etc., the fundamental challenges we have. We are interested, and in a couple of weeks' time, we've actually got a working group to look at this. Unfortunately, this event has come before then, but hopefully I can take things away from here and add value to the conversation with my particularly German and US colleagues. But the conundrum we have is we will only litigate where we need to and where it is meritorious. That doesn't mean we'll win necessarily or lose, but at least it has merits, and therefore we'll go with those. And where we can do that, we, as you said, we're fortunate enough that we can fund our cases. And the argument that comes back, and I'm sure, John, you've had this before, that will come from our CFOs who actually write out the checks, it's not the legal departments that pay for it, is, well, if it's a meritorious case and we win, why should I give a slice of that winning to a third party when I can keep the whole cake? So that's number one. And the flip side to that is, if it is not a meritorious claim, if it is something that we think has got challenges, difficulties, we'll strive to settle. But it's difficult to see why a third party would invest their money in a claim that is unlikely to succeed, or at least perceived as unlikely to succeed. So that's the biggest challenge. I think secondary and far behind that, some of the points that John raised, the perception of loss of control. Remember, there are a lot of stakeholders on these disputes already within the organization. You'll have the project team, you'll have the finance team, the external lawyers in-house, and so on. Everybody's got input and a stake. And then you add on to that a separate decision-making layer, which can complicate it even more. And I know I'm simplifying here, it may be that it's even internally we have internal civil wars when it comes to settlement. Some sections want to settle because they can release the provisions, other project teams will think, no chance, we want to prove a point, this was a great project we did, etc. So if you then add to that, well, hold on, you've got a third party whose approval you need whether you settle or continue. I'm putting it in very bland terms. I know it's a bit more nuanced than that. That is another factor we consider. So, but we look into these things. We want to keep our budgets as low as possible. The attraction of off-balance sheets for a litigation may persuade CFOs to go down that route, but we still fundamentally have that problem of meritorious claims which we can fund. If we couldn't, then obviously we would go to third-party funders, but where you can, you've got to explain to a CFO, well, what is the driver and the justification for giving away part of your winnings? That's, in summary, where we...
Okay. Nadya, I mean, from your own experience, do reputational issues also arise when you think about, whether funding is an option?
Yeah, absolutely. So my experience with litigation funding has been a little bit different, because prior to joining Barrick, I was with another mining company, which was listed on the London Stock Exchange. And it had a very particular business model in the sense that all of its assets were concentrated in one jurisdiction. It was an African state. So when the relationship between the company and the African state deteriorated, there was a lot of pressure on the business. There were restrictions in terms of export. There was an export ban. There was a restriction on export. There was regulatory pressure, tax pressure, and all sorts. So the company felt that its only option was actually to take the state to arbitration. And one of the considerations, as you mentioned, is actually the perception of obtaining third-party funding or litigation funding, how they will be perceived. So firstly, by the state itself, would it think that the company is weak? And that means that the assets are ripe for the picking, and it's just going to move into expropriate. The second one was shareholders. Would the shareholders think that the company is mismanaging the assets, the business? Would they seek responsibility from the directors? And the third one was the market itself. How would the market react to this news that the company has gone out and taken funding? Does that mean that it has no assets? It's on the brink of basically being a failed business. So this was one of the crucial considerations that the company considered when it was exploring the option of litigation funding. And there were two other factors as well that were considered. So one is, as Zubair mentioned, which rightly or wrongly within companies, there is this perception of loss of control, that if you approach litigation funding or if you obtain litigation funding, that would affect your strategy, your choice of lawyers, arbitrators, at what juncture you may want to settle the case or withdraw from the proceedings altogether. And the other factor which was considered was actually enforcement. This was something that was considered right at the outset because this was a several billion-dollar claim, and this particular African state didn't actually have a lot of assets overseas. So there was a question of what happens if the company did fail, the assets were expropriated, and you would only have this particular award to rely on, and you have to seek to enforce it across the world. Because one of the things I think a lot of lawyers and funders don't consider is that companies are ultimately responsible to their shareholders. So when it comes to these decisions, that is definitely a factor. And directors as well, when they make these decisions, they have to consider whether or not they may be personally held responsible for the actions of the company, and should the business fail, whether they were responsible for that. So this was definitely a consideration for the company that I worked for.
Very much so. Rocco, this perceived issue of lack of control, I mean, obviously within various insurance policies, there's obviously all different control mechanisms insurers have, but from a funding point of view, do you think that's misplaced?
Having worked on both sides of the fence in litigation funding and in after-event insurance, it has struck me how loss of control was always raised when I worked in litigation funding, but never raised in being an underwriter of after-the-event insurance. And I find that quite an interesting observation, partly because I think to myself, why is it that AT or insurance is seen to be non-intrusive, whereas funding is regarded as intrusive, and that's where control can be lost? And I think it might be down to the fact that you have a party paying bills and paying lawyers, which typically is a function of a client. And a comment was made earlier about there's an education process here. John touched on some of the points, but they're points that are probably known in the audience. It's contractually enshrined in the litigation funding agreement that the litigation funder can't control the litigation, can't give instructions, can't give any directions of when to settle, at what amount, etc., etc. So all those things are enshrined in a contract. So I think there is a problem with corporates and possibly others, but potentially, I think it's particularly corporates who tend to look at funding and worry about that loss of control. And the message still has to be given, and it's true of both sides of the equation, that the client, the claimant, is the driver of the car, and the litigation funder and the after-event insurer are passengers in the car. Now, that obviously is a message that still has to be drummed through. Obviously, other considerations have come to light over and above just loss of control. But it is peculiar how that one just keeps on rearing its head. And I think the answer is there. I think it just needs to be driven home as a message, and it's an education piece.
And John, I mean, do you see that just as the market maturing, in the sense that everybody's sort of perception of litigation fund, it started from looking after the impecunious claimant who couldn't otherwise pursue litigation. Obviously, it's become a much more sophisticated marketplace. But do you still see that as something, or do you have to mould your own offering to corporates because of that issue?
Yeah, that issue still exists, very much so. We've had some independent success with especially European general counsels in the last year, talking to them about, for example, competition follow-on claims. So that's a good example of where we can identify a claim that's either already through the regulator or maybe even through appeal, identify that they have significant damages, and talk to them about what to do about those damages. Because so many of those claims just go unprosecuted, which is kind of shocking to us. But we've also had a lot of success with our follow-ons, because to our own success in the U.S. with especially monetization of claims. So that's becoming more and more of an area we focus on. And there are two companies in particular where we've done significant monetizations of claims in the US, but they actually have European parents. And once the European parents hear about what the U.S. corporation did, they want to bring us in and talk about that some more and see what more we can do. But that's a small subset, of course, because it's a subset of a subset from the U.S. So that really still is an issue. But whenever we get those folks on the phone, actually talk them through what we do, what we can offer, we'll get sometimes the points that you raised about, well, we have plenty of money, why would we use yours? And sometimes it's a nice discussion, and the answer is, well, 2 years ago, I really could have used your money. Right now, I'm good. But 2 years from now, I might be calling you. And so those calls are great to have, too, because it establishes a relationship for the future. But no, it totally is a problem still, and reaching the right people. And it is both GCs or heads of litigation and CFOs. Because you have to know in the company who's really going to make that decision. And often, as someone else mentioned, sure the GC and head of litigation is involved, but it's the CFO who's actually to decide what money is used.
Yeah. So you don't time your conversations immediately after a serious loss.
No, we don't.
So I mean, driving down a little deeper. I mean, clearly, mainly corporates are defendants in litigation. Yeah. So. Obviously, the question of how you define success, even across a portfolio of defense claims. I mean, some companies obviously have hundreds and thousands of claims they defend. I remember going to General Motors years ago and I said, do you do all your litigation in-house? Because they had 300 lawyers. And they just laughed at me. I mean, but it was like 64,000 product liability claims. So in terms of defense, how do you explain that offering?
I mean, the best way to do a defense claim or fund one is through a portfolio. So if a company has a significant amount of affirmative litigation, we can give them whatever amount of money makes sense against that collateral, and they can use that for whatever they want. And often, easier to do in the US, of course, but often you can get the lawyers to take significant risk. So the company really has that extra money to then pay for the defense of the other claims. Yep. That's the easiest way to do it.
And in terms of, how you seek your return based on that, is that based upon what was the performance of the portfolio, but is that in a positive or a negative sense?
We really just rely on the affirmative claims.
Yeah. Yep.
So it's sort of giving the company a chunk of money and saying, use this for whatever you want.
Yep.
And they can use it then to defray the costs of the defensive claims.
Yeah. And in terms of maybe Nadya and Zuba, in terms of the debate you're about to have as a company. I mean, if you look at your own experience and think about where you think it might be attractive, what types of claims would that be?
I mean, if I can make just two comments, touching on what Nadya said a bit earlier. It's not that we're not interested. These are arguments that we have to have. You said, often, mostly we're defending. Siemens, actually, it's about 50-50. We are claimants and defendants. Where we're claimants, our customers, the utility companies, etc., are reputable, and the risks of enforcement and all of those things dissipate. I personally think that it's quite a powerful tool to have third-party funding and AT insurance. For very tactical reasons, having been on the receiving end of it. So previously, on a much lower value scale, but more frequently, we had Siemens Financial Services, so leasing agreements. And there you would have claimants who would have AT insurance and not so much third-party funding, but CFA, if we can just conflate the two, but the principles are the same. So when you've got an opponent like that who can just say, well, I'm litigating with no risk of costs on my side, barring the extremes, they're in a very powerful position to say, well, we don't need to settle, we don't need to be that sensible because somebody else is picking up the tab if we lose on cost and somebody else is funding it. And to be in that position is quite a strong driver. And having been on the receiving end of it, I'd like to actually use that possibly against opponents. So it has its attraction. I accept what you said earlier, that it might signal to the market, well, are you actually short of money, and is that why you're getting there? The flip side of that is if you can demonstrate, we've actually got money, and the other big point is you subtly convey the message that this case obviously has merit, sufficient enough for somebody else to invest in it. I'm not having to dip into my pocket because I have to. A third party is dipping into their pockets because they want to, and there's a big difference there. So just as a sort of strategy and tactics and messaging, I can see, really useful weapons there.
And I wonder if, following on to that point, if and it was mentioned before, but one of the goals is to allow companies to do what they do. Sure, my company this is what we do for a living, but pretty much all the other companies in the world do not focus on litigation as their prime business. So one of the messages is, we're freeing up capital and resources, internal resources, to focus on what the actual business is.
Yeah. But in that sense, if you take the cash drag, and it's a curious asset class that you don't look to secure it in the way you'd secure any other asset class. And your point on perception, Nadya, against what Suba just said, it can be flipped on its head, I suppose, in the sense that if there's a litigation funder out there who feels the claim is meritorious, that does send quite a powerful message. Do you agree?
Yeah, absolutely. I completely agree with Zubair. The example that I gave, this happened obviously a few years ago, it was about 5 or 6 years ago. So the market has moved, leaps and bounds since then, and the perception of that has changed. So it's about how you control the narrative. But just as both John and Zubair were saying, it's about education, and it's not really educating the GCs or the legal function. It's about going up to the C-suite level executives and the finance team, because they look at it in terms of how would the market perceive this? How would the investors react to this? If we have to declare this under whatever requirements or rules in whatever jurisdiction we're listed, how would they perceive it? And just as Zubair said, if you control that narrative and if you pitch it that way, look, this is a claim that it's come in, that we acknowledge it's a thing, but we're not really concerned about it, and we think we have a strong case. That's why somebody else thinks the same thing, and they're investing with it. So we're going to focus on making money, and then they're going to go off and take care of this claim for us. So that is something that is changing in that space, and it's going to take a little while longer for that perception to fall away. And just as Rocco and John were saying, the whole idea of loss of control is, I know it's not true, but for somebody else in the finance department who doesn't deal with this or who doesn't know the nitty-gritty of it, for them it's a serious red flag.
I think if I could, Nadya mentioned before that one issue for her claim was asset recovery.
Yeah.
And having come from big firm land, I can say once we won a claim, we thought that was it, right? We won, and now that's going to pay. As it turns out, that's very often not the case, especially in high dollar matters. So we have our internal asset recovery group now, but that's something that funders can add. We add from the outset. One of our primary considerations is recovery, and having just showing in-house folks that as well, rather than them having to go out and find an asset tracing firm and find some underwriters who can figure out if those assets are actually recoverable if they win. That's all a lot of work on top of the usual it's just claim meritorious.
No, I do agree with this. We do, as a firm, a lot of asset recovery, but a lot of lawyers sort of, they let a deep breath out once they get the judgment, and they don't really have the skills to do it after that. There's obviously some firms that are very skillful at that, but actually it's not really the center of excellence isn't within the law firm generally.
Sure. Yeah.
But in terms of how you target, so you address these themes in terms of education, Rocco, have you seen it change from, initially thinking it's general counsel more to the finance people, or does it vary?
There is no doubt a challenge there, because I think historically the model of both after-the-event insurance and litigation funding is to engage with law firms who have clients. And there is an issue with that, because fundamentally you're relying on the law firm to, one, fully understand the message, and two, convey it to a client. And I found in the past, sometimes you have excellent law firms who really engage in the discussion about litigation funding and after-event insurance and relay it to their clients properly and are able to address any concerns which might come back in their direction from the client. And equally, I found law firms who have struggled basically, or possibly are not interested. Maybe they don't think it's relevant to them or to their client base. And so some firms are distribution channels, I call them, and some other firms are distribution blockages because it doesn't go beyond them. And so I do wonder whether, the strategy is to engage more directly with the corporates. I take the point, and I have taken this point before from my own experience, GCs do understand what we're talking about, but then you have to have that follow-on conversation with finance, with board, and it then has to go to another layer. So when I talk about an education piece, I'm not understating that there's a big job here. It's not going to be a quick win. And insofar as litigation funders have this challenge, we've had it in the after-event insurance market as well.
Well, before we open up for questions, just touching on the insurance side of things, Rocco. I mean, in terms of the types of insurance arrangements you normally have sort of, go hand in hand with litigation funding. In terms of corporates, are there any differences, or is it broadly the same set of arrangements that you have?
So, I mean, the range of products we have, of course, look, you have to start off, before I talk about the products, you have to start off with the basic principle that litigation funders finance and after-event insurance doesn't. We provide indemnity. So, I don't want to sort of take away the respective benefits of both. And of course, we work together on a variety of cases. So, we do complement each other. But insofar as a type of product, you are right to ask that what do we do and what can we do for corporates? Well, yes, adverse cost cover, which can be converted into some form of security for costs, either by way of an anti-avoidance endorsement as a variation to that contract to make the policy non-cancelable, non-voidable, and the defendant's a beneficiary of the policy, or a deed of indemnity. We can also insure disbursements, so even though the corporate's paying for barristers, experts, court fees, arbitration fees, that can be insured and indemnified if the case is ultimately unsuccessful. And we can, on certain occasions, look at solicitors' fees, a percentage of solicitors' fees. We also can provide cross-undertaking and damages cover where a claimant is seeking, for example, a freezing order. And really, when coming back to the whole dynamic of working with a corporate, certainly from an insurance perspective, I can see an advantage of working with corporates because, first and foremost, they're sophisticated. By the time they've approached a litigation funder or an 8 insurer, they will have worked out, they've got a piece of litigation, they would have done their homework, they would have looked at the merits, they would have made the analysis that this is worth pursuing. So you probably won't have anyone dilly-dallying and sort of, umming and ahhing. They've made a decision. The question is how to package this, how to pursue this. Equally, they will have got all the relevant evidence, they will have preserved it, they will have done all the things you expect of any insured. They will have that sense of engagement. So in that respect, when you look at a corporate as a risk profile, that's a good thing from an insurance perspective, because you are dealing with someone who's sophisticated, who probably is involved in litigation on a periodic basis. So for them it's part and parcel of being in business, is what we do. We have to litigate, it's a sad fact of life, but it is a part of business life. Insofar as how corporates look at after-the-event insurance as opposed to litigation funding, of course, that only really becomes relevant when you have an entity that can fund themselves. And certainly one example I had was discussions with a GC with his panel solicitor about a particular dispute, and they were working on what are the options. Do we fund this ourselves, take the adverse cost exposure ourselves, and make provision for that? Do we, and they explored the litigation funding route, they looked at the after-event insurance route, they looked at probably a combination of these, and it was obvious that the GC was presenting the options to the board and asking the board to sign off on the options. He obviously made a recommendation, and it happened to be an after-event insurance. Now, as I say, we are not in the space of competing with litigation funders. We do not fund, and we often complement each other. But in that particular instance, it was clear it was a corporate who could bear the risk, who could finance their claim, and they decided to take a funding option, an insurance option rather than a funding option or put it all on their own balance sheet. So it is all very individual. I mean, insofar as we all have, and we have to accept this, and it's something we're all acutely aware of, we all have our own risk appetite. We find that whether we cross the road, we might fancy a bit of jaywalking crossing the road, and others might not, and want to wait for the green man at the traffic light. You know, that's normal, whether it's a personal thing or a business. We all have our own appetite to risk and our tolerance to risk. And businesses are no different, and that tolerance to risk might differ from one case to the next as well. So I think we all have to respect that as well.
And Zuba, do you think that'd be part of the conversation that you're going to have? You know, that insurance may be an option. I mean, in the old days, you know, some companies had, you know, in that very old thin market, legal expenses insurance, you know, which really didn't ever go very far. But obviously, this market's very different.
Yeah, and as Nadya said earlier, these things are evolving, and you know they're changing. From the last time we reviewed these things, the market is very different. The offerings are different, and we look at all aspects, including the underwriting and insurance. Just touching on earlier, you know, convincing a CFO who's got a budget, I think the arguments that we can run in an appropriate case is, look, this is the choice. You can invest, I'm rounding the figure, £5 million on a $70 million US dispute for the next 3 years, tie it up. If you lose that money. Or option B is you can use that to buy another turbine, and if you lose, you don't lose anything, but if you win, you give away a slice of that, and it then comes down to the number crunching and, you know, the margins, etc. But to answer your specific question, yes, definitely the underwriting, etc. are all part of the discussions that we have and will have.
Thank you. Thank you, everyone, for that. Any questions anybody would like to put to panel members? There's a little microphone. Could you give your name?
So it's Ayşe from Benchmark Advisors. More than asking a question, I think the other thing that General Counsel should keep an eye on is a litigation funder keeps really close eye on the budget of a law firm that will spend the money. Because I have spoken to a few corporates globally, and their concern was, okay, this law firm gave us this budget because I know this will sound bad, but they look at these really big companies like yours, Subaru, or yours, Nadya, like a gold mine. So they charge quite a lot. They say, great, I can get everything. I can go and stay in this big hotel, 20 people associated in one case. But John will endorse that. What we do is, as litigation funders, maybe that can be another question for, and something discussed with CFO. We get the budget from outside, from lawyers, and we keep very close eye. And we can feel your pain because we spend more time on budget and looking at every single bill they are doing than sometimes dealing with the merits of a case. But that is the value of add a litigation funder do, because we say to lawyers, you need to stop right now because this is over your budget. And the other thing is, some other litigation funder use that. Of course, so you mentioned meritorious cases, and I totally agree with John. When you speak to a lawyer, like he said, this is a great case. But as litigation funders, what we do is we ask them to look at damages, asset tracing. And if they don't have money, we give that as a seed funding for them to look at all the cases. And so we might have 15 cases online, yep. But as a litigation funder for free, I can say, just concentrate on this 7. So that's my comment.
Okay. Yeah, go ahead.
Sorry, just a couple of points. One is, in terms of gold mine, believe me, in-house salaries, you would never think that we are working for gold mines. And
not at all.
That's one, unless you get paid in gold, Nadya.
I wish.
We don't. I'm not interested in being paid in turbines or anything, so I'm afraid that's where it is. In terms of legal costs, actually, my experience has been the solicitors' budgeting are excellent, especially, you know, with the cost budgeting, etc. in courts, they've improved, and we try, when we go for a pitch, we have almost like a precedent H cost budget sent out to our pitching firms to say, right, to compare like with like. But the real cost overruns I've found isn't anything to do with the actual lawyer's cost or even counsel's cost. It's the expert's cost, etc., which dwarfs, in my view, on a sizable construction case, the expert's costs dwarf the other cost. And that is something that I'm not sure to what extent a litigation funder would be able to manage and control.
Yeah, I mean, I think the answer is we can, right? We do, and I totally agree with Aisha. It's a great point. And it really depends on the company, too. I think, obviously, you're very sophisticated, and we see cases that come in the door, and companies spent $50 million or more on fees and expenses and gotten nowhere, or even the opposite, gotten bad decisions. And we have to take a step back and say, we need to rethink the strategy. We need to figure out where we should be litigating, how, and most efficiently. And it really depends on the company. Some are sophisticated, and some, unfortunately, are not, and just kind of take it for a ride.
Well, my main takeaway from that issue is that we have to have this at the Holiday Inn next year. Anyway, on that note, wanted to finish within time with 1 minute left, so I'd just like to thank all members of the panel very much for their contribution. Oh, sorry. Oh, yes.
One more.
Sorry about that.
Sorry, I just had one question.
That's okay.
Caroline Harbour at Forsters. It's just picking up on something that Rocco said about insuring a cross-undertaking in damages. I can totally see that that's a really attractive prospect because it's a thing that often really gives companies pause to stop and think before getting an injunction. And so I guess my question is just around the practicalities of that. Is that something you only offer for cases that you're already, where the injunction is like an add-on to a case that you're already insuring, or would you do a standalone cross-undertaking? And if so, how does your due diligence process, how does that work with the speed at which you need to get an injunction, basically? Just curious to hear.
First, the answer to the first part, it can be standalone as cover. The answer to the second part is actually it's a lot of work because you have to look at the merits of the case as if you're writing an AT policy, and then you have to then start looking at the potential loss that could arise from certain assets being frozen for 2-3 years. So there's two parts to that. I have actually issued that policy within a week. So, but to be fair, it was on a case where I already had an AT policy. So if you give a lead in time, hopefully that gives you a bit of an indication.
Thank you. Well, thanks, as I said, once again to all members of the panel for your contributions, and hopefully you enjoy lunch. Thank you.
Well done. Yeah.